If you've traded markets for a few years, you'd know that periods of great consolidation often lead to extreme moves. Today, we talk about the buy side, whether the demand can hold up after 4 days of extreme selling throughout this week. We've seen the FOMC, we've seen Apple earnings, and now we come to the third trifecta, the non-farm payrolls or the jobs numbers in the US. Well, there's some things that are a little bit sneaky underneath the hood that the central banks are doing as well that we need to talk about. Plus, we need to understand whether the economy can be held by just 10 stocks. Let's go through it all right now. Well, welcome back everybody to The Daily Show, where we talk about markets around the world, and we've got an amazing show for you today because there's a lot of things that we need to be talking about, specifically rotation that's going on in the market. If it's your first time here, give it a little love, make sure to subscribe, and of course, smash that like button if you find value in today's video. We will be covering quite a few topics, including news, macro, and of course, our charts and hottest levels. Let's discuss Apple's forecast. Up after hours, EPS was a beat. And overall, it looked okay with the iPhone sales. However, again, forecasting sales growth declines are headed. The worst years since back in 2016. So what does this mean for the stock moving forward? Well, it's going to be a very interesting point. We'll look at Apple later on in the charts, but I want to bring up one point before we get into the rest of the data, and that is an update on the central bank flow of funds. Basically, we know that central banks are a huge component of really the inflows and outflows of this market right now. You can really see the front loading of these particular charts and how the markets have reacted. Well, it turns out the repo market is starting to get a little bit of activity, probably because of the regional bank failures. And unfortunately, this is the type of thing that you look at and you go, oh, not again. Are the central bankers coming back in? It's not enough to note just yet, but it does potentially help support the idea that there is some demand around this level. Now, if bears are able, there's been outflows in recent days. So if bears are able to take this zone, which we'll look at later on in today's video, there's a good case to be made that we'll go down and flush into 4,000 and fill all of these gaps we've been talking about before, and maybe even stretch down into these ones. Now, that would be pretty significant if it did occur. We'll talk about yield curves, everything else coming up in today's show. But I wanted to just alert everyone that central bank movements have started to show a little bit of flow back in over the last couple of days. And I don't believe it's a coincidence. Got to be these regional banks, and they're starting to kind of backdoor support them with liquidity. Let's move over here to what's going on with forward PE. Just as an investor, remember, is the market cheap? Not really. Is it super expensive? No, it's nowhere near as high as it was, but I love using forward PE as one of the reasons, not the only, but one of the reasons that you might like markets. And this is an updated chart during this earnings season. You can see here the 25-year average, which is around 16.8. So basically speaking, it is not that cheap to buy markets right now, but it's more of a point where I think the upside is relatively limited. And we've shown this using the data recently and talking about all of that. So, of course, we've talked about the idea that when we get reads similar, we're only usually seeing about a 6 to 7% maximum upside in the S&P and more of a 10 to maybe even 12% downside from just the data alone. Let's talk about the seasonality of the market. We find ourselves in May. We're obviously not to the end of May. During 95 years of history, we usually have seen May sell. However, it hasn't sold over the last decade. So this is starting to become more of that. Maybe it is time for May to be the seasonality. Let's move into some other history stuff though. And I think this is the big one. I've been really going on about copper recently, and I've been talking about metals and energy, and in particular, the decline of those particular stocks due to demand destruction that is caused by the Federal Reserve and the impeding cuts that will eventually happen, though hopefully those cuts happen in 2024 if you're a bear, yeah? If you're a bull, you want cuts to probably happen a little bit faster. Now, if we think about surging in 1 month lows, what's occurred here is a whole bunch of energy stocks are closing on their 1 month low, a very negative signal usually. Here are some of the reads that we get past that point, and you'll notice it's a very flaky couple of months. First month, second month, third month, up until really 6 months. Things can get a little bit nasty. Here is another read of some of the most recent points. You can see with the commodities side, usually this type of data actually is very strong. And it really goes into only 31% of the time when market's more bullish over a 2 week, 1 month 46, 2 months 46. And if you know anything about markets, you'll know that generally markets are around 68% positive. So again, reads like this just really back in that idea that there is some destruction going on here in the energy market. Here's another one that we got the other day, which started all of this, which obviously was our first read on how bad energy looked. Here's another one in terms of commodity spot and the Bloomberg index. And when we see this happen, which is only 11% of the time, usually the annualized returns are pretty negative. Since that point, it's dropped about 6 to 7%. So it's already well on the way to getting that annualized return pretty quickly. And it is also in line with a period of, we've seen that nice growth, and usually there might be one more uptick, but in general, you kind of see that weakness into the Q3 of the US. What I'm trying to dictate here is just to show you that swing traders or even bears in markets, it's also about selection. If you're trying to short Apple all the time, or you're trying to short Nvidia, which by the way did hit one of our zones the other day, then it's very, very difficult. You're trying to short the best stocks in the world during a time when central banks are still pumping a little bit of liquidity, even though they're lying and saying, oh, they taper all the time. Well, we can see that's not true with that chart before, but they're claiming they're tapering. They are still doing it. In general, that helps those particular ones. Remember, big tech or the top 10 have become defensive sectors in this market for people that are going bullish, whereas the rest of the market, regional banks and other things we'll look at, have just been really, really bad. Here's what's actually happening underneath the hood. The NASDAQ composite obviously has been increasing, but it's been increasing with just a few stocks. When we get reads like this, these are some of the data stats that come out. Again, not that great moving forward over the short period of time. Update to smart money versus dumb money during this drop here back down to the lows. It looks like smart money, however that really is starting to buy in. Again, it doesn't mean a turning of the tides, but you can see that that's happening. Generally speaking, during dips, that's when you usually see these types of purchases, and then they usually cut off somewhere around the halfway point and then sell back in. That's kind of like how money would flow though. They start buying, they buy an average down their position, and then as it rallies back up, they basically start selling off their position. And of course, it makes sense to this chart, but there's an update for you if you're interested. Let's talk about rotational flow. Of course, gold's been doing incredibly well right now. Great if you've been in gold. Of course, the first big move of gold, I certainly wasn't fully on top of this week. It happened before the FOMC event, which I wasn't really thinking would occur. It broke out. It's doing it, I believe, because yields are still dropping, especially the short term, and gold does like that. I've talked about it. I still have a long-term picture of gold at $3,000. Now, I'm still also medium-term, kind of weak on gold here. We'll see whether it breaks out and actually keeps going strong. We'll look at it soon. On the short, kind of trending term, we'll look at that as well because that's a little bit different. Here's the 5-day. You can see regional banks getting absolutely crippled. They're probably oversold. We'll look at that on the charts later on. Even though they may go lower later, we'll look at where they're at. Defensives have been holding up a little bit better, as have semis. And yeah, gold's been really the standout. Here's the last 5 days. And you can see here that again, energy stocks have, here's the last day. Energy stocks have declined. We've got metals going down, two of our most hated sectors at the moment. Regional banks got destroyed thanks to that whole PACW thing. And again, defensives up. So defensives are moving up as we go into this demand zone. So as we go back into the demand zone, theoretically, the market's turning a little bit safe. And as I mentioned, Goldman have reported that there has been an outflow in the markets recently. So we need to be on edge here when it comes to these levels. I think that it's still a great period of time for somebody to really be fast and nimble with both buys and sells. On the medium term, well, I've told you what I think. And of course, I told you that also last week and those levels. And so far, it is up on the short side. But, we need to break this zone if you're a bear. Let's talk about RSP. What's going on with RSP? Well, this is the equal weighted S&P 500. If you took out everything to do with this big tech kind of bull move, you would actually see a new low being formed by the S&P 500. Now, the RSP is not solid enough to go off by itself, but I tell you what, it is not looking healthy. Like you look at this, and I think a lot of technical analysts are going to claim that's a left shoulder, head, right shoulder. And in this case, the right shoulder is also lower than the left shoulder. Now, if that was to come true and we broke this neckline later on, I always like to do proofs in the market. So let's do one together. And all we're doing here is we're just trying to prove whether that level makes sense to previous periods. So basically, that's the neckline break. Let's go out and have a look at the previous history. And you can see the interesting thing about it is it actually wipes off everything that was put on since the pandemic highs. So that basically wipes everything else off. Now, a lot of bond traders and a lot of pretty smart people believe that in this level here is what kind of is artificially going to be managed by central bankers. That's kind of the level that they believe it could get to. That would reset a bit of PEs, and obviously that would be a great position. We'll keep watching this. It's just interesting to see that proofing of the technical setup should it be occurring. And RSP on this particular chart does look weak. Now, you can't say that's just, oh, wow, we're going to short it, because it's just not enough. It's the same thing with consumer discretionary versus staples. 1/3 of the US economy is the American consumer. And usually with a nice bull run, like a real bull run, not a fake bull run or a bull run being run by 10 stocks, then generally you will get XLY, XLP coming with it. It shows you that there is a recovery in the American consumer. Consumer discretionary is starting to beat staples. That's not what we're seeing in this so far bull run. It's just keeps dying and lying off. So that's not really a great sign. What about copper? No movements here. We're looking on the weekly, daily, no new lows. Maybe non-farm brings it. But yeah, we need copper to go through if you're a bear. If you're a bull, what you want to see on copper is a breach of this 4.0087. And if you get that, kind of puts like a double bottom in for now. And maybe that kind of is signaling again further rips in this market, which is still possible, obviously, especially if the Fed bazooka the market, which they look like they're starting to put a little bit of liquidity back in. Hopefully they taper that back off in the next couple of days. Let's move over here to the US 2 versus 10-year. This is starting to uninvert. So we haven't seen this really start to uninvert for a while. Now, remember I mentioned this on the channel. Make sure you subscribe if you're interested in this type of stuff, that when we see the inversion is usually when we see the recession. So you don't ever see a recession usually be called officially. Yes, I know you could argue there was one last year, except they changed the wording on it. But generally speaking, you'll see it uninvert, which means it goes back underneath the 1%. So this is not unusual. This is basically what it's showing you is that they expect a lot of Fed cuts in between. And of course, the 10-year might hold up because they say, well, maybe the economy will survive. So it's that differential that we're looking at here. When we go over to high yield bonds, they've made a recovery after dumping in the morning. They did make a new low. So you can see they made a new low, but it's not enough to go off. High yields are not telling us yet that the market is extremely sick. They're coming with this sell-off, which is consistent. If we saw high yields go like that and it was all bearish and the market was like sitting at a demand, high chance that the high yields would be correct. The next day would break underneath, and that's why we watch it. Treasuries, nothing much to report, sitting in the middle of nowhere land. You'd need yields to drop off for that to do well. And then we move to the dollar index. Now, the dollar index is tough. Look, it's more than likely still going to continue to go on to the short side. We don't know whether this is accumulation or distribution, but this particular move, the way it then came back down, isn't really conducive with generally a rally style move. You can see here the long leg doji. We're actually on an outside candle here for the weekly. So we've made a lower low and a higher high. Interesting. So we're basically at either accumulation or distribution. Weekly closes will be important. Non-farm payrolls is going to be important. If we end up going back up, I just don't have too much opinions on this. There's been some great currency trades. US dollar CAD is a particular one we did in our private community. I think that's been an exceptionally good little level on the short end there, and that's gone through. However, yeah, outside of the currencies, the US dollar has been tough. If we do end up getting a nice weekly closure or daily closure underneath 100 though, I believe we're moving further and lower back into these demand cycle areas over here, back underneath parity, and I don't trust parity, which is 100. I would not trust that. So important times for the dollar, non-farm payrolls usually sorts it out. And that brings us to gold. I know everyone's really excited about gold, and it's at its third time touch, which usually third or fourth are the breakers, so makes sense. This is a super big weekly close. We don't know whether it's going to close higher than this one over here, but you can see that it has rejected before. It obviously rejected here. Big run up. I see some of the people in the comments like, that's right, Tom, it goes up. I am still, remember, an investor in gold. I'm just not I haven't got this bullish move. So yeah, a little bit sad that it went up. But remember, there are many opportunities in the markets. If you were short energy stocks and you were there, you did okay. If you were short iron ore, you've done fine. If you were even short the market this week, you've done fine. Gold, was a standout in terms of its huge move off that trend line. I did think it was going to weaken off here a little bit, and you could see it was kind of doing this. Once it got through 2015, though, any pullback you would have to believe was going to be bulled. What does it do now? The problem is non-farm payrolls. I know it's a very big event for the currencies out there. This is the big currency event, jobs numbers, that tends to lead into a massive dollar move, which can push gold around a lot. There's also a lot of illiquidity kind of moves going on. You can see here that it gapped up. For anyone that shorted that, congratulations to you. I could see like snaps of new highs and then pullback downs. It's more of, do I have a high probability style position on this right now? If you're in the bull trend, you can't really be afraid of it yet. You'd be looking, if you were to be afraid, you'd be looking for a new snap high, a breakdown back underneath something like 2028. That would like solidify a small time frame change of trend, and then something like that would occur. But for now, it's making a series of higher troughs. So we're basically at higher lows, and we're seeing still higher highs. So we'd like to see a new higher high. Weekly closure will be key. If the weekly gets above and closes high, then I would think that pullbacks will be met by buy demand, and probably means that the dollar is going weaker as well. Let's look at gold stocks. They look pretty good. This is where it all began for me. This Wyckoff bottom was the strong buy this year for gold. This 61.8 retracement to certain levels was pretty interesting as well. And if we go over here, let's just quickly get this over for a second. I want to get my fib here. So there's our fibs. And when we came back down to this level, this was a good little double bottom. So you can see here the low, the small steal, the rally. I haven't really been too interested in it in here, but if you are in gold stocks, you could see if we get a weekly closure above this level here, where's the next stop? You'd have to think it's in that 40 zone. So gold making a resurgence in the stock world, and you can see how much it's coming back up and how critical when you go to the weekly this level is. So yeah, interesting point. Certainly a great weekly close should it rally up. That will probably solidify further bullish momentum on the gold stocks. Let's move over to oil. This is the one I've been really interested in. So oil on the, let's call it the actual market here, maybe because it's found such a big buy in this demand zone. If it pulls back to a 61.8, day traders may want to be around there on the smaller time frames. For me, though, I'm staying away from oil crude, and instead I've been, of course, on the stocks. So the sector itself, as you saw with the data we provided earlier today, that it's super big. And XLE 78.11, it's fallen another 1.11%. This is a huge drop. I would expect some relief at some point, but I do actually think that energy will make a new low underneath this point, move back into this 70 to 68 level. And I don't really expect much help for energy stocks throughout 2023, or at least this first period. If demand destruction is here, which the Fed has been causing, usually energy is the first to suffer, and it comes down to yields and understanding all of that stuff as well. And we also brought up some great stats from before. Let's move over here. At least that's my opinion. It's my opinion, obviously. Tesla, let's move over to this one. It is still stuck within nowhere land. If we get a nice big jump out of the gates, that would probably solidify this as an island reversal, and we should move towards 180, as I've mentioned before. If we keep doing what we're doing here, we still have to maintain that we're going towards that gap fill, a 61.8 retracement, and also the 145 kind of level. So we're looking for that in terms of Tesla for now. It still looks weak. It's going to require, though, a market breakdown, which we'll talk about soon. NVIDIA, check the weekly close. This is going to be a big one. Huge shooting star coming off that watch reaction level. That was the first time we really saw that, but it's more significant than that. And it comes down to a lot of stocks. If we close like this, then make a new low on that low for the next week, we're basically solidifying this to be some type of UT or UTAD in a distribution range. So that can really say that, well, one of the hottest stocks, one of the big runners of 2023 is actually tipping over. And that's what we're looking at this point. This is a fairly large rejection candle. It came off an extremely good zone. It took everything that you'd want it to do. So it's like a liquidity steal. And it really does kind of show you some weakness. Apple has been a lot less clean cut. I actually expected it to get back into here. This is what I wanted to see with its earnings. So kind of go like this and then like that. And there is no new low. So it's still in an uptrend. Even after the earnings, because it was up after hours as well, We've got a high, we've got a low, we've got a higher high, we've got a higher low, we've got a higher high, we have a higher low. So unfortunately, it's still in an uptrend for anyone that's trying to go bearish on it. I'm still looking for Apple to push this agenda. We don't know it's going to, but that's the level I'm looking at. As a trader, you have to wait. You have to be patient to wait for your levels. Otherwise, you're not really getting involved in it. And look, this stock has maintained its bullish status the whole way through. There's been no lower low swings through this whole trend so far on the daily above. So we're looking for that. We haven't seen it. That will probably be a tip as well for the markets. Now, everyone wants to short regional banks. And I understand you want to short something that is obviously in trouble. The problem is, has it shorted too far? This level here and the way it structures around here, I would say this is where you find some buyers recommitting to KRE. I'm not one of them, but I'm just kind of getting at here that it's been very short and this is well outside of anything. This is where a lot of people are trapped. And this is the point where I don't catch falling knives, so I'm not really interested in it from that perspective. But you can see the structure on the higher timeframes and see the sell-off. So yeah, regional banks, it's already probably happened in terms of the sell-off trade. The initial sell-off was big. This was always very scary. Usually something that drops 20% keeps going for a while, and this could be the shakeout. But these are going to extreme lows. You put indicators on that, you'll see what I mean. Let's move over to the DAX. Still trapped, still in the range. Is that a false break? Well, we'll find out if we actually do something like this. If we do that, then it's another one of the markets around the world showing you that the highs could be in for now and that we're swinging to new points low. For the DAX, if we break to low, 1582, down here, that's kind of like your first take profit and your second take profit on the shorts. It's a pretty shorted index, and certainly a lot of people are going at it. What about the XJO, the Australian market? I've been very negative on this. I am waiting for copper to, of course, fall through those levels to really solidify further sell-offs. I wouldn't be surprised at all, though, to see the Australian market do something like this and move into the 7100s. It looks like a nice little turn here today, but I'm not very bullish on the Australian market at this point. I think the downside is more than the upside. I'll load up the UK 100 because I know there are quite a lot of people that are interested in this market. We'll just quickly chuck that on the charts here. And you can see the weakness. The main weakness here is due to energy stocks. So if energy stocks keep failing, then you'd have to expect the FTSE to also find it. It did come up to a great level to see shorters. It's come back down to probably a little bit of a demand. I would say a little bit lower might be the case. But yeah, the FTSE is not an easy one. There's a reason I haven't left on the charts because it's not really a great level either way, I think, for statistical trades. Let's move to IWM. This is an interesting one. This is a good chart, this one. So IWM had the best short on this week. I love this chart very much. I put it in the weekend video. It came up early in the week, I think it was Monday, and then just shorted the rest of the time. Weekly close will be important, but I'm looking at the futures more than anything else. So I've left the short zone there as well, just so you can see what happened. We got the shooting star. We got the follow through. We got the pickup through the FOMC event. It was beautiful. And then we came down. No new closures underneath 1700. 1700 is a defended level. If we break 1700 below, that kind of solidifies this as potentially being a huge distribution. That then pushes 1650 and then maybe even that cascade effect. So we've got to be really careful. The Russell 2000 is pretty sick. It's nothing like the other markets. Like you look at the S&P 500 versus the Russell versus the RSP versus the Qs, and the Russell is so bad in comparison. And that's kind of like the real economy. The US 2000 and 3000. The 3000 has 98% of all of the stocks in the market in it, I believe, in terms of market cap. Let's move over to the Qs on the expected weekly options low. Nothing much we can get from the Qs themselves. Here is the futures market, and you can see it's just trading in the middle of the range, nowhere near the weakness of the top tech. Big tech, not weak in comparison to the others. Maybe it will become that way, but yeah, not weak yet. Breaks and closes above here, well, that will create squeeze events because at this point, we all know where everyone's stop losses will be. They'll just be above these levels. So of course, that's what you're looking at. Let's move to the S&P though, because the S&P is at demand. It's underneath now the daily 20. So it's underneath the daily 20. It's closed, but it didn't close on its lows, which is not usually a super bear signal when it doesn't close on its lows. We have gaps now to the upside, which are priced, which I put in here in this chart. And of course, we have that little bit of liquidity being injected over the last 2 days. So will that find the buyers? We have a gap at 40.90 and also another little miniature gap at 41.66 to contend with. So let's talk about some scenarios here for the US 500 leading in. First up, squeeze indicators are showing the pain could be to the downside. That's probably replicated by that Goldman outflow kind of concept. But let's talk of the levels on the smaller timeframes. First up, we'll just go to a 2-hour to understand. So if we take a fib of the whole move, so let's take a fib of the whole move, you'll notice that we get into these wicks up here. So this is a fib from the high to the low currently. Heavily traded zone is still in that 41.25, so that's the most heavily traded zone. We know that that was supply, so that will be an important level for the markets. If we scroll a little bit lower and go 5 minutes, one thing did occur over the last 24 hours. We basically went low, high, lower low, higher high, pull back, then found rallies off that point. So 40.56, where that unfilled gap was, where it was, now it's filled, that's where we saw defended line buying. So basically down here is where you think buyers are. And at this stage, it's kind of saying that there should be rallies that are going to push towards at least that 40.90 gap and maybe even up until this 40.99. You can see the structure up here, the supply up here. Now, if we're able to break through 4100, that's where the bulls, I think, get a little bit more control, because basically you'd be going from a low, high, lower low to a higher high. You'd probably pull back from that point, creating another excellent kind of strategy. Then you'd move into the heavily traded zone, and then you'd find, well, what happens here will be paramount. New highs above this level and closures, I would say we're going for new highs and we're going to squeeze. So now it's basically fast and nimble. Theoretically, there's defense around this 40.60, 40.50 zone. You saw that in the small time frames. A closure below this low here on the daily, I believe that opens up underneath 4,000. Why? Because we know the heavily traded zones are down in here. Plus we have gaps at 39.68. So probably the more likely cascade effect would be closures under here, movement down, get the gaps. So get the gaps that are in these levels and then move into 39.69. So that's the type of zones that I think are most important here in terms of the charts and what we're looking for. And yeah, basically it could be a little bit of a rally through this session. 4100, certainly a contended zone. Breach of that probably brings in the rallies just again to 41.25. The bears have to show themselves on this if they're wanting to control this, since we now have a lower low. So that should be where they control the market. And if they're able to control the market, then push a lower low, we go to fill all the gaps. Or we just sell off right now, close below, fill all the gaps. Either or, I like all of those trades. That's what a trader does. You create a certain scenarios. It's what I do for the private community as well. If you're interested in some of that stuff, let me know in the comments down below, and I'll start creating a little bit more strats towards the chess kind of scenarios and the theoretical zones that if we hit them, these types of plays are the more likely statistics from that point. That's usually what trading is. It's not really about prediction. It's more, do we see something? We have the patience, we react to that. And some trades you'll see and you'll say, that's an 8 out of 10. That's a 7 out of 10. That's a 6 out of 10. Like how many times you'd win it out of 10 times. Once you know your stats on things, that's when the game changes really in this kind of vicinity. What about going on with maximum pain? Let's take a look at max pain together. And if we have a look here and we go 5th to the 5th, you will notice that we have 400 puts. Now, this is a huge unwind from where it was earlier in the week. So 405, 46,000, 400s, 66. Max pain is 410. I don't really think it matters too much this week, but just to show you, you can see 400 is unlikely to be broken through the Friday trade into non-farm payrolls. Now, Bitcoin, or Bitcoin as I call it, that has entered into the questionable short zone. Now, it's too early to tell whether it is, but it's made the higher high, which we expected in the last video. And now we're looking, well, we're obviously looking for this to see weakness, which it has so far. I'd like to see it go underneath this level here, pull back into that heavily traded zone, and then basically look towards the short side. So we like the buy. This is where bears have to commit. If you close above this level here, really the only next thing is 30,556, which is a watch level. I'd say that's fairly easy to fill. And then from that point, well, you'd be making new highs, at least in the temporary zone from Bitcoin. So for now, the weakness and the zone has been hit. And yeah, it's quite good. Non-farm employment change is coming 1 hour before the market opens. We know this moves currencies a lot. Dollar index, gold, all these types of things move. Even S&P 500 a lot. Be on the watch out for that. And as a reminder, if you enjoyed today's video, subscribe, smash that like button, guys. Thank you so much for watching. And of course, come and grab a couple of free cheat sheets. Join us on our Twitter and everything else that we post. Thanks so much. Bye for now. See you next one.